Okay, welcome everyone. We'll start our first lesson and in new unit 3, which will go through budgetary control. My name is Anjum Satar and my email address anjum@ukversity.co.uk. So we are doing ATHE level 4 extended diploma in accounting, and today lesson will go through LO1. LO1 is our learning outcome 1. Understanding financing options for different organizations. So before starting our lesson, first of all, we'll go through what we're supposed to be learn under this module, this unit. So please, so the aim of this unit to be develop knowledge and ability to identify the sources of finance. So we need to be develop knowledge. What are the sources of finance available? Which one is the best and why is the best, and what sort of circumstances in which different sources of finance is the best, because that's the budget for your cash, and it's very crucial to be manage your money because we are limited in terms of the resources and we have unlimited want. According to the one great scholar Neil Robin, he mentioned we have unlimited wants and we have a limited resources, but we need to make sure we use these limited resources effectively to maximize our return from these limited resources. That's why we need to be make sure we use the resources effectively. We need to make sure we use the resources effectively. Managing and improving working capital. Working capital means the running capital, and the functional department means functional area like marketing, production, sales, and all these is known as a functional area within our organization. So today lesson will go through LO1. LO1 is learning outcome 1, financing option for different organization. We'll discuss different organization. Will go through the financing option. We'll describe the main sources of finance, explain the financing options for organization, recommend different and efficient, discuss the benefit. We'll discuss what are the benefit of long-term finance, and we'll discuss Camprey model for sources of finance. On the basis of this, we can decide. In the second lesson, we'll go through how we can manage the cash, and we'll discuss about the cash budget and working capital, what is meant by. We'll go through some ratios, what is how we can manage, and then we have a learning outcome 3, budget report, and we'll prepare budget report. We'll discuss about data. We'll discuss the budgetary forecast and how we can. So today lesson will be focused about a loan, debenture. Loan, of course, you borrow money from the bank, is called debt financing. Debenture is long term, is sort of like you secure it, can be again the asset, or you can issue the piece of paper to be get the finance. It can be secure against your asset. Business grant, yes, government, business angel, those are the rich people, they give the money to the business owner or invest. So on saving, mortgage is part of you're all well aware of long-term loan. Share capital, issue shares to the public as the shareholders, and you normally get dividend. Bank overdraft mean you are rent, and this is short term. Crowd financing, different the organization come under the crowd financing. Return profit is mean your profit previous year which you're not distributed. Invoice financing, you have invoices, sale invoices, purchase invoices to collect the money from your customer and supplier. Those you can use to get the money as the sources of finance. Lease and lease of asset financing. Leases, two types: operating lease, finance lease. If you have a finance lease, asset will be yours in the day first, and the operating lease you carry on and we can get the asset. Asset mean anything you own it, anything has a economics value, that's called asset for the business. Okay, advantages and disadvantages of different sort of financing method. So if you do internal and external, if you do debt, and so which will go through the explanation of the main features of funding, these different methods. We will discuss with the cost and benefit. We'll discuss about short-term funding, what is, and all this model, Camprey model, which we'll discuss today lesson. So we'll start. So again, today lesson will go through LO1. My name Anjum Satar and my email address anjum@ukversity.co.uk. So this is the inductive contents which I just discussed with you, which what we're supposed to be learn, which is given, and now you can just spend 1 or 2 minutes or a few minutes, just think about and reflect, how much you know the sources of finance. Do you know where the money you can get? Do you know which one is the best for you? It's not mean somebody offer you the credit card and you quickly, and a lot of people say the credit card is a sweet killer. So we need to be think about what are the consequences. Are you happy to pay 39% interest rate on the credit card? Are you happy to pay 15% interest rate? Are you happy to free transfer? You're happy to transfer with 3% transfer fees for 12 months. So you need to look around your needs for the business. Are you happy to be transfer 2.5% interest rate for 5 years, let's say? Yes. So you need to think about which option is best for you. You need to look around why you need money, for how long you need money, how much will cost you. So you have to decide. So think about here a quick example. You are going to buy the car insurance. Yes, couple of you have a car and you need a car insurance. Especially in UK, car insurance is a compulsory thing, so we need to think about car insurance. So let's say you have to pay £500 car insurance. That's your for a whole year, so £500. So now we need to think about, you don't have your own money. First of all, if you have your own money, you have a spare money, you can use that money. Second, okay, now either you can say you pay monthly installment. Yes, monthly installment you carry on paying. But if you pay monthly, that costs you, let's assume that costs you £650, because there is an interest around 30%. Round it, you have to pay in a year. That costs you 650 if you pay monthly basis. If you pay yearly basis, that costs you only £500. So £150 will cost us more. If we know what we can do now, instead we'll buy the insurance from the insurance company and we'll pay the monthly to them. What we can do, we have a credit card and they are giving offer on the credit card to transfer or on the purchases for 12 months. There is a 3% transfer fee. So what we can do, we transfer £500 one credit card to other, and we can use to make the payment £500. So on £500 times by 3%, how much will be cost you? It costs you only £15. It costs you how much? £15, and you can pay or set direct debit with the credit card company instead of insurance company, and you carry on paying towards £500 what you're supposed to be paid. So that's we need to be look around, because money is a crucial. Lot of businesses default are not sustained in a business, like in the UK BHS, which is called British Home Store, number of year in the business. Only the problem, no cash, no business. Yes, no cash, no business. Cash is a lifeblood. So what we need to look around, lifeblood. If you don't have a cash, you can't really sustain. So we need to be look around. So next, now we can look around. Now you can rate yourself how much knowledge we have in this area. It's a vast area. We can look around different perspectives. So first of all, we look around the types of ownership. So our assessment criteria 1 describe the main form of financing for organization. So first of all, we need to know the organization. Then we need to know the form of organization, form of finances. So we are looking organization. So organization can be sole trader, partnership, and limited company. So sole trader is a 1% business. All the risk and reward goes, and you can make your decision whatever way you want to be. So you need to look around there, because it's a small scale of business. You need a small money. You don't need a big money. So we need to look around. Partnership is a partnership. Two and or more people come together and start a business and partner, and we can share our money, and our combined portal can be big. And if we still need it, we can individual guarantee. Everyone can get some money or can borrow, or they can use our draw. We can look around. Limited liability. Limited means in case of default, nobody can claim from your personal asset, like a house, rent, cars, or various other your personal assets belonging to you. Okay, then we have a charity. So we need to look around. If you're running a charity, if you need sources of finance, what you need. So charity is regulated under the Charity Commission and the Charity Act 2011. 2011. Okay, then we need to look around limited liability partnership. The funding company can fund the following ways: retain profit, short-term liability, share capital, loans, and trade payable. So different organization, different. So partnership, what are the advantages? What are the disadvantages? Why is this partnership business is benefit, and where the money will come from? So we need to look around the profit can be separate. We can look around the control, the risk and reward will be the Company Act 2006 is regulate the companies are the limited company or public limited company and company registered under the company house, and IFRS is consist of International Financial Reporting Standard, and IAS is called International Accounting Standard, which we normally follow and we should follow if we are operating. So limited liability partnership, we are a partner, but we can register as a company in the company house in the UK, and it's called limited liability partnership. So nobody can claim from. So now we look the sources of finance. So what are the sources of finance? Those are available and those we can use to maximize, and we need to look around these. So sources of finance, guys. First of all, when you decide sources of finance, you need to look around. You need money for the short term or you need money for long term. So sources of finance will be short term, even it's come under the overdraft as well. Yes, sources of finance. Overdraft can be short term. Further, short term loan for the short less than a year. If you're getting the things are the money you require, that's called short term. Normally, overdraft is a short term, not given here under this heading, but it is also is a short term. Okay, long term is more than a year, and this linked with the durations, which will go through further in the assessment criteria 1.2 and 1.3, which we can further explain these in detail. So we can look around long term sources of finance. So we need to always look risk and return. Risk, higher the risk, higher the return. Normally business say, but how much risk you can bear? Finance for the small and medium enterprise. So you need to SMEs, and you need to be look around those turnover is less than 50,000 and less than 250,000, and they require to be registered in the company house for 50,000 if you want to be registered public. Then we have some others now are becoming quite popular in the banking sector as well. Islamic financing, which is don't have a fixed rate, is based on Mudarka and Muzarka, which is we of course we're not touching in detail, but this is also option where the risk and reward is not fixed. There are varies. So we need to be look around, because as a Islamic point of view is there, because they say the fixed interest is not legal under the religious perspective. So they have a flexible. So we need to look around those. We can look around sources of finance that as well if you have a that belief. So we need to be look around equity. Equity mean you issue the shares. So you need to think about you go for the debt financing option or equity. You issue shares to raise the money, or you go to the bank and borrow money. So debt always, just you need to remember, debt always it's cheaper than equity. So if you go base rate is called basic interest rate, which is set by the Central Bank of England, or in other countries known as a state bank. So we need to look around the state bank. We have a basic rate 0.01%, which is a less than 1% now. It's almost nothing. Yes. So we need to be, if we'll go to the bank and we have a good credit scoring, we can get the loan maybe 1 or 1.5 or 2%. So, but if you issue shares to the public, the shareholders, they are expect at least 10% return. So which one is expensive? So equity. But equity holder, if you don't pay the dividend a year, so because they are owner in the business, they have a voting right, they have a proportion in the business, so we can say, and if you don't pay them, of course they can't claim legally against. So we need to look around. So higher the risk in equity, higher the return. Okay, so we need to look around equity, debt, hybrid, leasing, and venture capital. So all these are different sources of finance. So when we decide the sources of finance, so please remember first thing, cost. So debt is cheaper than equity. We earlier that's term of the structure, and we need to look around. Interest rate, we need gearing. Let's say think about high gear. If you drive your car in a high gear, what will be happen? Just saying. High risk, yes. So high gain, if you have a gaining ratio, debt divided by equity, if you have a more debt and you have a less equity is very high. Let's say you have a 90% debt and 20% equity. It means 90% company or the 90% house. If you have a mortgage and you only pay 20%, so 20% your equity mean your capital in the house, and the 80% is your debt, is 80% house is not yours, and we are saying is mine house, is my house, it's not yours until you paid off all the mortgage. So bank can claim. If you don't pay, they can take the asset back. So we need to look around accessibility. Not all the sources are available to all firms, so we need to think about not all the sources are available to all. Okay, that's fine. Any question? So we need to be look around next now. So please look around this. We have SMEs. We need to look around the financing issues. We need a few assets. We have little past history. We have a weaker control. We have a funding gap there where we need to look around. Potential investor can be banks, business angels, venture capital, government solutions, institutions. So we can look around, improve market, purchase of own shares. We need to look around, the specific help is available now, like coronavirus, furlough schemes, and 80% if you have and the previous. So that's all we need to look around. Tax incentive, we can need to be keep in mind. If you buy the asset first year allowance, you can claim back from the government. So all these factors we need to keep in mind to make sure that we are fully aware of these, each and everything before making the decision. Next, 1.2, we're looking to explain how the financing option can be assessed by different organizations. So how many types of key organization? We discussed sole trader, partnership, and limited company, and even we discussed charity. So we need to think about what are the best for you, and we need SMEs are the big organization, the private limited company or the public limited company, is the sole trader or partnership. So short term is less than a year. Like if you need raw material, payment of wages, rent, insurance to pay, that's we can use it short term. Sources can be trade credit. You can get, let's borrow the goods on the credit, loan from the commercial bank to overdraft or short term loan. Add the commercial paper, which is can be again the secure. It can be, we can issue the paper for less than, and we need short term, but sometimes can be higher interest there. So 1 year to 5 years, that's called medium term purchase. Modernization, if you want to renovate something, you need a heavy advertising, you need money for this. Sources of finance can be borrowing from the commercial bank, public deposit, lease, we can from the financial institution like a banks and various other private financing. Think about payday lender. Have you anybody experienced payday lender? If you buy, your salary will come end of the month. You're running out of the money. So we need to. Okay, sometime always family friend, your grandparents is always good sources of finance. So we need to keep the good relationship with them always. We always need to be, but even in a commercial world, of course, moral and ethical responsibility to keep good relationship should care about, but they can care about you as well, give you money if you need it. So that's why we need to. But if you borrow it, pay in the time when you borrow it and when you make or when you have a commitment. So long term, more than a 5 years. So purchase of land you want, plant and machinery. So you need to look around. You can issue the shares, debentures. You need to look around the long term borrowing. You can look around the loan from the financial institution. That's all. So explain how the financial option can be. So which we can look around. When you assess it, so you need to look around quantum of money required, how large amount you required. Money is not available through the single source. Maybe you can look around, I can use some overdraft, which is 30 days free. I can, and we have a free transfer option on the credit card. I can get 5,000 from there. My cousin family parents, whatever partners are happy to give me £4,000 for a year, so we can use. Urgent required, we need to look around, and the cost of procuring the same, so we need to look around. Cost of finance, if you're financing, how much cost, through bank, through interest. So you need to keep in mind, unless this is some sort of guarantee project, which is a higher risk factor, we need to look around if we don't fulfill. So all we need to be look around before deciding. So what we learn in the previous RLOs, assessment criteria, which is 1.1, we discuss about debt is a cheaper than equity. We need to look around, is it required for the short term and the long term or the medium term? All these we need to be look around. Okay, next we're looking the recommend most efficient financing. So first you need to be looking around the factor choice of funding. You need the amount you require, the advice is available, loss of control, we can control it, the length of the time, the cost of the money, and the risk involved, all these factors. So then we can look around sources of finance, can be internal and external. So internal, the money internally within our organization, we have an asset spare, we can sell it. We have a spare tallies, we have a spare something, we can sell it, we can generate. So that's why, guys, it's not only the Boxing Days we buy the lot of stuff and put in our house, in our cupboard, and we never use it. Basically the waste stuff, we are missing the opportunity. If you have a money, you can do the things from it. So opportunity cost always need to be. Opportunity cost mean that the opportunity you're availing, the opportunity you're missing, how much is costing you the opportunity you're missing. So the opportunity you're taking should have more benefit, more advantages than the opportunity you're missing. So always we need to keep in mind the opportunity cost, the concept. So time, short term, long term, medium term, which we already discussed. Okay, internal sources of finance. So what are those? You need a retained profit. The previous year profit, you can use it to fund your various things. Sale of stock. You have a lot of stock and you can sell it. Maybe sometime your company is selling the cheapest stock, but they need the cash. They have to pay the wages. If you don't pay the wages, think about, you're in the media, you're in the press, your workers will leave you, and you're legally bound as well. So sale of fixed asset. You have a spare building, you can sell it, but please, lot of company make the mistake. They need the money now and they quickly sell the long term asset, which is asset means anything you own it. In future you want to expand your business and you don't have a building, you don't have a plant, so we need to look around as well. Okay, debt collection. Okay, you're supposed to be collect money from your debtors, from your customer. So what you can say, yeah, a couple of you already learned about settlement. Early settlement are called prompt payment discount. You give them discount, say, if you pay now, we'll give you 10% off on the invoice which is outstanding. So they may be some customer happy to take the advantage, and you will get the money and you can use it to finance. Honor. If you have a own spare money, you can invest in the business, and there is advantages. Don't have the fee repay, no interest. Disadvantages can be limited amount of, because maybe you don't have a lot of savings. Saving and other nest egg. So entrepreneurial will be often invest personal cash balances into the cheaper fund. The finance is the readily available investing fund. The personal saving maximize the control of the business. If you issue shares, so you lose the control and the shareholder can kick you out and through the voting right, because the shareholders are also owner in the business. So because the share is a part of business. Share, as you can say, share mean the part in the business, how much they own. Okay, so that's we need to keep in mind. Borrowing from family friend can that's also be the common and the less costly as well, but we need how much we can borrow, and maybe we can use the mixture of sources of finance to reduce the cost as well. That's also we need to look around. Okay, credit card, yes, that's another source of finance, but please be careful because the credit card is normally is quite expensive source of, if we don't have a promotion. So all we need to keep in mind as well, credit card, the return profit, we discuss, the profit of the previous year you retaining as advantage, no interest on it, and you can use it. Sale of stock, yes, you can, and you need to be, it's a quick financing, and but there's no interest involved, but it can be disadvantage. We are reducing the price to sell it. Internal, we can sell it. Fixed asset, which we discussed. Asset, which we can, asset is mean anything you own it, anything give the economics, like building, plant, machinery, all your assets. Debt collection, we can collect the debt from and the invoices, we can use it as I mentioned earlier. And advantages, of course, is your own money, you can raise it. And the requirement of the finance at the various stage of the business, at start state inceptions, because where the starting the business, during the expansion phase, of course the technology, you need to look around what we need to be, maybe at the development stage, new product, maybe you can look around some working capital or some your long-term asset, when you need to buy, develop a new market, you need to be foreign direct invest. Maybe you can look around merger and acquisition, that can be day-to-day financing. Working capital is known as a running capital, which is mean the capital like asset have two types, short term, long term, or we call current asset, non current asset. Current asset means it's most liquid asset, which is you can convert into the cash. So like trade receivable, inventories, cash itself, these are the prepaid. Prepaid mean you paid advance to someone and you can get the money back. So so we need to look around the working capital. And fixed capital mean the plant machine. This is known as a long-term asset. So long-term asset, which asset we can use more than a year. Okay, working capital is mean running capital is equal to current asset minus current liability is equal to working capital, and these are the working capital. So we need short-term asset, we need long-term asset. You need to be look around. If you have a short-term asset you are going to buy, you need a short-term commitment as well, like less than a year. You can use overdraft, you can use some to settle. Okay, then we look in the M1. If you want to be work towards merit, yes, which we have a 3 assessment criteria, pass, merit, distinction. So M1M is discuss the benefit and the problem and organization taking long-term finance at the cash. So we need to look around the sources of finance, which we earlier discussed. We need equity and debt financing. What is so the finance raised by the issue the shares is called the equity. Equity means the share capital, and the long-term debt is mean through different financial institution. So we need to look around short-term, long-term, but here we're looking the long-term. Long-term mean more than a year, or it can be more than 3 years, depending on the nature of the business and the commitment, because every company. So we need to look around instead of why bank is offering me, come on, borrow the money. Why I need to put the money in my account and paying top of interest? So you need to be very careful, because it's not mean you have a lot of cash. You need, that's also be the missing opportunity. You need the cash to meet your immediate and a bit spare, like if you have some emergencies. So we discuss internal and external sources of finance, guys. Good to be look around more in details, and we discuss then we look around a quick look at the various sources of finance, owner fund and borrow, which we discuss. Okay, this is a Camry. Next we looking 1D1 evaluate. Yes, evaluate mean we need to look around what we're supposed to be, and we're looking this model here. Okay, so this stands for C is the character of the buyer. What is the buyer character? How you think, perceive the world. Do you have ability? Do you have a financial ability to borrow and repay? Always, if you, that's why the people say credit card is a sweet killer. You use it, you don't have ability to pay back. So that's why it's illegal to give the credit to somebody they can't afford it to pay you back. Okay, margin is the return on your investment. You need to think about the purpose. What is the purpose of the loan? Why I'm borrowing money? Amount, how much I am borrowing, how much interest will be, how much cost. Repayment, what will be the repayment term? Is it 30 months I need to repay all, or it like a mortgage, you need 15 years, 5 years, 20 years, 25 years, 30 years, or even 35 years? Insurance, do we have an insurance against as a security insurance? Maybe you're ill, you can't afford it to make installment, but you have an insurance it. Okay, a couple of you heard about PPI, payment protection insurance. Sources of finance, we discuss about these can be external, that's leasing, issue share, trade credit, yes, government grants, and all advantages and disadvantages each source of finance. I'm not really looking and reading from the slide. You need to make sure in keeping in view of the cost in term, and you need to look around what effect will be on the overall the performance of the company. Yeah. So all these we need to be shares. We need shares. I have two types: preference shares and ordinary shares. Ordinary shareholders have a right to vote, and the preference don't have a right to vote. Preference will get the fixed return on their investment, like a loan. And ordinary, even if you struggling, if you can't, if you don't need to, you don't pay the dividend, and the other will get fixed dividend, and ordinary will get. Okay, these we need a good knowledge about equity and debt financing, hire purchase agreement. We can normally cars and things, mortgage normally we use for the building. Trade creditor, if you buy the things and you can get 60 days, 30 days. So you need to be look around. You receive money quicker from the customer. You receive in 30 days. You pay your supplier in 90 days. Their net will be 60 days gap, so you can sustain in a business. So we need to be look around. So venture capital is pooling capital into form of limited company. Venture capital company, they have a different lot of money and they invest in the various projects like HS2, HS3, which is a fast train from Manchester to London and from Leeds to London, and that's two different lines will be, and the time will be reduced. This is a huge investment required, 106 billion pound is required. So we need to be look around. That can be a venture capital. So UK government, various other private companies, and some even the Chinese company for the few projects they have investment as well. So we can look around venture capital, and I copied the link for you guys. It's quite good to be do the quiz. Huh? So what you can do, copy this link, and then so just go through from here, just copy there and just play with this quiz. Huh? So it's quite good to be develop understanding sources of finance, what are the advantages, disadvantages. So you can start here and then you can look around. Downside of issuing shares to the investor, you need to look around. Is it loss of control or is it what? Huh? So is it right now? Okay, so you need to make sure, and even you do wrong, carry on doing. At the end will shows you answer. You can review as well where you went wrong and why. You can think about as well. Then we have extra resources. What you can look around, just copy, paste this link, and you can look around even different slide with some facts and figures as well. Which is I did explain you the concept. Maybe further you can deep out, because the level 4 we need to make sure we are good understanding, because level 4 is the first year degree in university, and why the sources of finance, key consideration, internal, external, cost, return, profit. All this is quite good to look around. And second link is also quite good. Kaplan is a publisher which is quite popular. Kaplan books, you couple of you heard about. And just think and just copy the link and go through the chapter 14 is basically they publish the book. They have, okay, you can look around there. A lot of it's all been explained: short term, long term, medium term, sources, what are the effect, market price, what will be the cost, what will be, there are some numericals as well. We're not doing a lot of numericals here, but we can look around those, the cost and benefit analysis, like I mentioned you one of, in shape of insurance, how much will cost. So that's all is quite good to look around. So we'll keep up to here. Today lesson we learn about the sources of finance. Sources of finance can be internal, external. Sources of finance, short term, long term, medium term. Sources of finance, debt and equity, and we need to decide which one. We need to look around the cost, we need to look around the duration, we need to look around the purpose, and we need to be look around what effect will be on the overall performance of the company of these are decisions. So all this we need to be decided. It's quite crucial to make the right decision at the right time, and you need to keep in mind what the effect will be on the goodwill as well as the overall cost of the company. So that's all to the lesson. Until lesson 2 we'll go through our learning outcome 2, and then we'll carry on learning outcome 3, and we'll finish, and the last lesson we'll go through assignment brief. So please, if you have any question, if you're listening this recording, just drop me email. My name Anjum Satar and my email anjum@ukversity.co.uk, and I hope I'll speak to you all during our next lesson. Thanks for listening. Thanks for attending. Thank you. Bye bye.